The public metrics of Hollywood wealth are completely outdated. For generations, the entertainment industry measured its elite by upfront salaries, box office performance, and back-end syndication percentages. But in an era where streaming buyouts have suppressed long-term residuals, the true power brokers of entertainment have completely shifted their capital allocation playbooks. They no longer view Hollywood as their primary destination for wealth generation. They view it as a high-yield cash flow engine designed to fund their true financial objective, the early-stage tech ecosystem of Silicon Valley. Elite actors have realized that traditional investment vehicles like index funds or public equities are too slow to build generational empires. Instead, they are quietly routing their liquid cash into private venture capital pools. By operating through shielded family offices and exclusive investment syndicates, stars like Ashton Kutcher, Jared Leto, and Robert Downey Jr. became the blueprints for this modern corporate pivot. They recognized that a single early-stage seed allocation in a software-as-a-service or fintech platform could yield greater geometric wealth expansion in 5 years than an entire lifetime of studio movie contracts. An elite actor does not invest in tech by clicking a button on a retail brokerage platform. They operate in the restricted, highly exclusive world of private placement seed rounds and pre-IPO allocations. The mechanical barrier to entry in Silicon Valley's top-tier rounds is notoriously high. Elite founders do not merely want cash, they want strategic capital. This gave rise to the equity advisory model. Instead of deploying millions of dollars of their own money, sophisticated actors trade their global distribution networks and cultural leverage for deeply discounted founder shares. They function as stealth marketing accelerators, weaponizing their massive digital impressions to drive consumer adoption for an app or enterprise platform, while their equity compounds in absolute privacy. Furthermore, the structure of these investments is heavily insulated. By routing their capital through specialized investment vehicles, such as Kutcher's A-grade investments or Sound Ventures, these actors pool their capital alongside institutional venture funds like Andreessen Horowitz or Sequoia Capital. They gain access to heavily gated Series A and Series B rounds long before the public even knows the company exists, legally locking in pre-IPO valuations that insulate their wealth from standard economic downturns. The final stage of the Silicon Valley playbook marks the ultimate escape from the Hollywood ecosystem. When an actor relies purely on production companies to greenlight their next project, they are perpetually vulnerable to market trends, studio mergers, and age demographics. They are essentially high-priced laborers. But when their underlying net worth is tied to compounding enterprise software, cloud infrastructure, or digital payment rails, their financial dependency disappears entirely. Today, Hollywood's richest stealth investors have built self-sustaining autonomous wealth machines. While they are walking red carpets or sitting in film trailers, their private tech portfolios are processing global data, capturing subscription-based recurring revenue, and scaling market share across the digital economy.